academic director of IBS requested me to record some important aspects on BASEL 2 and BASEL 3. That's because the students, in fact, they're all bankers. They will be appearing for examination just day after tomorrow. Actually, he asked me to record, in 2 pages, one of 20 minutes or another 20 minutes. And here, as far as the CAIIB examination is concerned, it's all on MCQ only. As it is, I have taught them risk management. I have taught them, balance sheet management also. There I have given MCQ specifically for BASEL 1, BASEL 2 and BASEL 3, and also for a balance sheet management. That apart, I have given at least almost 100 case slates, situation analysis and risk management. So I thought there is no point in again repeating the same thing. Instead, I thought let me record this with the full description of what is BASEL 1, what is BASEL 2 or 3, so that this will be useful even for other students like MBA students, finance students, commerce BCom students, and others who are appearing for some internationally acclaimed diploma courses like FRM, CPA, CMA, because this risk management is of late is assuming a lot of importance in almost every institute, in management institutes. The risk management is a separate topic. So I thought instead of recording purely examination oriented MCQs, I thought I will record full description about BASEL 2 and 3, even though we don't really go into much history of why BASEL 1 and or 2 or 3 as the case may be. So that is the purpose. It runs to more than 60 slides. I am not going to read all the slides. Ultimately, I will try to make it maybe 30 minutes, 2 pages. One is all about BASEL 2 and 3, then about as far as India is concerned, Reserve Bank of India regulations as far as implementation of BASEL 2 and 3. At the outset, I would like to express my gratitude to Satish sir and Mohan sir. Satish sir is a founder director of IBS. They have been conducting a lot of programs for CAIIB. Those of you who do not know what is that CAIIB, what is this Indian Institute of Banking and Finance, they will be surprised to know IABF is the largest institution in the world, which is in Mumbai, largest institution in the world. In the sense, it has over 1 million members, about 700 banks has its members, and it's one of the toughest examination to pass. Just to say a word about me, I'm a banker, retired from Bank of Baroda. I passed the CAIIB way back in 70s, to be exact, 1979. The passing percentage was, believe me, you can check out 4% or 5%. Thousands of students will appear and only 5% will pass in that. And during those days it was very difficult for us because if you talk about foreign exchange, there was only one book of Kamath. If you talk about banking, there is only one book of Tannen. Now there is so much of information revolution, and you get all the information in Google and so many coaching classes. During our days, it was extremely difficult to pass. And fortunately, my message to you is present my banking friends who are appearing for the examination day after tomorrow. Now the passing percentage is about 20%. Still 80% of the students fail. So you can imagine the rigorous type of examination system, and the topics all about trade finance and foreign exchange, risk management, very, very difficult topics. I wish all the best, and tomorrow being Ganapati day, hope Vinayaka will bless each one of you and all my students of IBS IBS is known for its extremely high percentage of passes for some of the courses which we, not only me, all our top executives like general managers, AGMs from bank. This is the only institution, according to me, where you find the faculty are highly successful, accomplished bankers from top level. In fact, one of the programs which I conducted with my another faculty, Ramesh sir from bank again, our passing percentage was 90%, 90 to 95. So this IBS is known for its quality and for the intensive training. For the last 4-5 days, they have been conducting what you call capsule programs to preparing the students. They go out of way. So I'm really feel proud to be part of such an institute, even though I've been teaching for I've taught more than 10 universities, and including London Metro, in London, and University of Wales, Cardiff, and Charles Sturt University of Australia. I taught in a couple of foreign universities, London School of Business and all those things, but still I find this institute really cares for quality. So I am recording this for and on behalf of Institute of Banking Studies. Mr. Satish is the founder director, and Mr. Mohanan is academic director. There are a lot of people, team like Mr. Biju, Krishna, Alex. They are all working very hard to see that we must achieve better results. All right, this is the background I should mention, because then IBS team and my students, bankers, they know about me, but then I'll be posting this in YouTube also to help others, like MBA and other FRM students also. I have adequate exposure, and in fact I have been associated with the Institute of Banking and Personal Selection, for which I prepared MCQs for credit analyst and senior risk manager, and some of the MCQs I have given to these students also. And for most of the MCQs on BASEL 2 or 3, you will be in a position to answer better if you go through these slides. Maybe once this video is over, I will be posting these slides also to the website of IBS. Okay. Well, friends, having given this much of introduction, let's go ahead. So my focus today is not on pure risk management, particularly BASEL 2 and 3. As I told you, mostly exam oriented. Day after tomorrow there will be exam. Thousands of students will be appearing for this, and particularly PSBs attach a lot of importance for this qualification, because once you pass this, you get 2 increments that helps you for further promotions. I am making this type of remarks because others also can really get benefit out of this video and out of whatever descriptive slides which I have prepared. Generally, PowerPoint slides means there will be only bullet points. You will not see any bullet points here. They are all highly descriptive, so that even without my help, even if you don't want to listen to any video, by having a quick browse through, quick glimpse of this, you will be in a better position to answer the questions in the examination. Okay, so let's go ahead. And believe me, the BASEL Accord, you will understand later on. All my bankers, students, they know. I am just addressing this particularly for MBA students and those students who are appearing for FRM, etc. The BASEL Accord runs to hundreds of pages. Even the guidelines issued by Reserve Bank of India runs to more than 200 pages. So instead of reading those, so many pages, if you simply browse through my slides, that would certainly help you a lot for your examinations and even for interview. Those of you for MBA and MCOM, BCOM, BBA students, when you go for into particularly for banking sector, or maybe insurance, this risk management is one of the topic which is gaining a lot of momentum of late. Okay, I wish all of you, and I hope that this presentation will certainly help you. Okay, all right, students, let's go ahead. Now the first slide, risk management, BASEL 2 and 3. explain in plain language. I have tried to put it in, there's a lot of technical terminologies, lot of formulas and equations, algebraic equations. So I have tried to put all these things in as simple manner as possible in colloquial language. Terminologies I can't change. There are no substitutes for that. To explain that, I will be using colloquial language. And as far as these slides are concerned, I have used the exact terminology used by BASEL Accord and as given by the regulatory banks. Like, for example, it may be Fed Reserve for US, it may be Bank of England for UK, or it may be it is a Reserve Bank of India for us. So I have terminologies have not changed because it is very essential, particularly for your examination for MCQs. You should remember the exact terminologies so that you will be in a better position to tick the correct answer. Okay. Now the first slide talks about risk management, basically 2 and 3, explained in plain language by people call me expert banker, they call me acclaimed professor. I have been teaching for the last 20 years for so many universities, all finance, banking, investment related topics. They call me an acclaimed professor. This title I have not put. I've done MBA, I've done CAIIB, I told you, I did it in 1979. And then I have done a couple of diploma courses, and I have done MBA in marketing also, a diploma in computers. And why I am mentioning all these things, not to pat my back, whether who am I? Can you believe what I say? What is my credibility? It's a question of credibility. So whether do I have that competence, capability to talk on a very complex topic like BASEL 2 and 3? That's the reason I gave my background, not to boast myself, not to blow my own trump. Okay, that way I'm very humble. Okay, all right. Let's go ahead. What is BASEL Accord? It's a global financial regulatory standards announced by BCBS. Wantonly I'm using all these abbreviations because particularly for my banker friends who are going to appear for the examination the day after tomorrow, you should remember what is BCBS, BASEL Committee on Basel Supervision. One of the arms of the Bank for International Settlement. It's, that's IBS, established way back in 1930s. One of the main objective of this IBS is the Bank for, I'm sorry, I have to correct it spelling right now. I think I should do right now because I am talking about IBS. I have typed IBS. It should be BIS. I'm extremely sorry. Right now I will correct it. Give me just a second because I don't want to pass on wrong any information, wrong information. This is Bank for International Settlement. I have typed IBS. I'm sorry. Established 1930. One of the major objectives is to combat the global financial disasters. For example, the Great Depression, that's why it was established in 30s, 30 Great Depression you would have heard about. And failures of, for example, Bank of Baron, 150 years old bank was brought down overnight and its share was sold at, I think, one pound sterling. Which was so well established, and one Nikhil Leeson, he committed such a fraud. We'll not go into the details. I'm only giving the background why this bank, Bank for International Settlement, has been established to combat financial disasters and to at least limit the failures like Bank of Baron, Lehman Brothers, recently one of the largest investment bankers in the world, it failed. And again, some of you must be aware, particularly finance student, the subprime lending crisis of 2007 and 8, and which has saw so many banks, hundreds of banks failed, particularly in Western countries and in America. Though India was insulated to some extent, but there was not much contagion impact on the Indian economy. We are saved. Okay, so now this is known as BASEL Accord, and they are all financial regulatory standards, and those standards are evolved. Again, if you see my slide, I have just put a picture there. It is BASEL, it's also pronounced as BASEL. It's also pronounced as BASEL. BASEL is a city in Switzerland. It's very beautiful, and you can open that. I have a lot of photographs on that. All this, top executives, right from Reserve Bank of India governor or presidents of other banks. Initially it was started only for 10 members, then so many other countries have joined now. So they meet there to take stock of what's happening in the global economy, particularly financial sector. Finance is the mirror of the economy, So they evolve a lot of regulations so that such financial disasters do not recur. Okay, so they talk about bank capital adequacy, what are the tools to reduce the impact. So there are stress testing, liquidity risk. As we go ahead, you will come to know all those things. And my bank friends to whom I have been teaching, they know about all those. It's only just a refresher course, just to recap, which they have already studied in the last couple of months. Okay. Let's go to second one. And they also set reform measures to improve regulation, supervision, and risk management. These are their focal areas. And why reasons for Basel III? Because actually they started somewhere in 80s Basel 1, then again a lot of reforms have to done in Basel 2. Now we are into Basel 3. Believe me, Basel 4 is going to come. In between there was Basel 2.5 also. They go on reviewing, and they bring modifications. They bring more stricter measures so that we can reduce such type of recurrence of financial failures. There were some drawbacks. I don't say failure of Basel II. There were some drawbacks. Inability to strengthen financial stability, and despite prescribing that there should be minimum 8% capital, the capital reserve was insufficient, and the risk management approach was not really comprehensive. And there was some gaps in there was no clarity in definition of capital. There was some gaps in so it's Basel III, as I can say, come over all these drawbacks or lacuna, whatever you call. And the major objectives of Basel III. Now, my dear bank friends, whatever I'm telling, whatever written in the slide, has been done very thoughtfully, very sensibly, taking into account some of this will appear as MCQ also. So if you see in my slide, within the bracket I have given some important points. So please remember those points. That would help you to answer MCQs as far as Basel 2 and 3 is concerned. Okay, I think most of the questions will be on Basel 2 and 3, not Basel 1, because Basel 1 was very, very simple. It had a lot of limitations also. I will read out so that it gets properly recorded. Even if you don't want to read, I will not read the entire slide as such, only keywords. What are the aims and objectives of Basel 3? Quite possible it can be on MCQ. Possible, quite possible. To minimize the probability of recurrence of crisis to greater extent. I have already mentioned that. Within the bracket I mentioned improved assessment of default probability. They have brought in a lot of formulas, algebraic equations, how to write from where, capital V, small a, and capital R. There is another one var, var in capital, that is variance. When you calculate a standard deviation, that variance, it is notified by capital var. This is value at risk. Okay, value at risk. There are a lot of formulas in that, how you can calculate expected default, loss at default, so many terminologies they have brought in this accord. Second one is to improve the banking sector's ability to absorb shocks arising from financial and economic stress. We can see in the last 2 years, COVID, the COVID has brought havoc. COVID has caused such a crisis. It has affected the entire global economy throughout. That was shocking. So how to absorb these shocks during such period? particularly when you go for expansion of credit, what are the precautions to be taken. So they have given a sophisticated risk assessment process. It's a highly sophisticated process. The third objective is to improve risk management and governance. There, for example, one of the tools used is the securitization of credit default swap, though credit default swaps were misused to a greater extent during the subprime lending crisis. Now they have been improved upon. A lot of strict norms have been stipulated so that they are not misused. Finally, to strengthen banks' transparency and disclosure, you open any annual report or K10 report, what is known as US, you will see at least 10 to 15 pages only on disclosure norms, on risk management, or ALCO committee, ALM. Now, one has to be transparent, one has to be honest. So what are their risk exposures, how they are managing, who is in charge of, like for example now in most of the banks, not only banks, even in other corporates and financial institutions, NBFCs, you come across chief risk officer. You would have heard about COO, you would have heard about CEO, CRO, chief risk officer. So that shows the crucial aspect of risk management. There is a top executive called a chief risk officer in some of the organization presently. I was mentioning recently, I was fortunate enough to prepare, I don't know whether it's proper to mention here, for Institute of Banking and Personal Selection, they were recruiting senior risk officer. In this transparency about market risk, operational risk, and liquidity risk. Of course, there are as many as 20 types of risk, but they have described these are the major risks. The risks have been classified major into five heads, and again sub-heads. If you put all this, as many as 20 types of risk, reputational risk, so many risks are there. All right. So these are the aims and objectives of BASEL 3. My banker friends, you also should remember this, whatever I have written. I have put in a lot of efforts. I have gone through 300 pages of RBI regulations, 400 to 500 pages of BASEL awards. Only afterwards I have prepared. Please believe me, I have not copied this from any Google or any book. Every slide I have prepared, thoughtfully. Okay, I take full advantage of this. Key element of reforms. I'm not going to read very descriptive slides here, not bullet points. If you can observe this, I will simply mention what are the key element of reforms, what exactly it means. As we go ahead, I will give you the explanation, some examples also. So, key element of reforms as far as BASEL 3 is concerned: better capital quality. The capital, earlier there was even in ratings and assessment, there was not much difference between a corporate and a small retail borrower. So now the capital quality has been improved in the sense, if you follow whatever guidelines the BASEL 3 has given. Second one is capital conservation buffer. You have to, so if something goes wrong, to fall back upon, we call it buffer, So there is capital conservation buffer. This is another key feature of BASEL 3, and they started with the 0 to 2.5%, to be achieved in phases in different period, and that period has already been over now. Actually, it was to be as of 31st March 2019. So now every bank is expected to have 2.5% as capital conservation buffer. How to calculate that? What is the formula? Everything I have given here, because there are almost 70 slides here. You please work out this, particularly for those who are appearing for examination day of tomorrow. I think I have already worked out, and IBS was kind enough to arrange last minute doubt clarification classes headed by all the top GMs, AGMs of the top 5-6 banks. So you are lucky enough there. I missed that because I'm sorry, I don't know the top person here. based on commitment given to one of the foreign university. I have been developing course content consisting of 60 lessons and 25 hours of video recording, and the deadline was really frightening me. That's one of the reasons I'm sorry I could not really participate in the session which IBS had kindly set up, and I hope all your doubts are cleared. Now, what is conservative capital CCB? There is one more CCB also. One by one, I will explain. But anyway, I am not going to read. But I have given very detailed, descriptive presentation here, so that you need not at the last moment you need not take a book, or you need not search in the Google, or search the notes which other faculty have given. Okay. So first one is better capital quality. Second one is capital conservation buffer. Okay, 2.5. That is that's maximum and compulsory for all banks. Okay. The third one is counter-cyclical buffer. Counter-cyclical buffer, CCB. This is also one of the key elements of Basel III. The counter-cyclical buffer, it has been introduced. The objective is to increase capital requirements in good times. See, the earlier one is in bad times, to fall back often if something goes wrong in bad time. This is for good time. In good time, how much a buffer you can create, so that in the bad time you can use this to expand the credit. You can't stop credit. The economy gets affected, and particularly PSU banks, according to Reserve Bank of India guidelines, even private banks, foreign banks also, they are expected to comply with what the guidelines that have been given by Reserve Bank of India. So counter-cyclical buffer is another very effective key elements brought in by Basel III. Then what is the minimum common equity, quality capital. Earlier we are not talking about quality, now we are talking about quality capital. So what is tier 1 capital, what are its components? For example, the minimum requirement for common equity, the highest form of loss absorbing capital, if something goes wrong. It has been raised under Basel III. Earlier it was only 2%, now it has been made 4.5%. The total capital is 8. And later on, when I go to the last part of this presentation, we will come to know what are the guidelines given by Reserve Bank of India. For Indian banks, it has been made 8. World over, for all the global banks, according to Basel I, right from beginning, it was 8. Now Basel III, it is risk-weighted assets. Earlier, it was not risk-weighted asset. That's why I'm talking about the quality capital. Now it is risk-weighted asset. What is RWA? Only for others, those who are not working in the banks, you may not be able to understand. I will come to that later on. For all my bankers friends, they know what is risk allocated, what is risk weighted assets. So you must have a 8% risk weighted assets for all other banks. For Indian banks, it is 9. Okay. Now the overall tier 1 capital requirement, not only common equity but also other qualifying financial instrument. That has been increased. Earlier it was only 4%, and now it has been increased to 8%. Although the minimum total capital requirement will remain as 8 level for other banks and 9% for Indian banks, yet the total required capital will increase to 10.5. For us it is 11.5, because mine is Indian banks, 9 plus 2.5, 11.5. Okay. My dear friends, for CAIIB aspirants, all these percentages are very important, because if you have seen the last couple of years examination, many times they asked, is it 2.5 or 1.5, what is CCB? So they asked, please remember all these things, and what is the minimum capital requirement for Indian banks, 8 or 9, it is 9. So even though I have repeated, you please remember this, even if you by heart, I have given this in Kannada and in Tamil also, by pata, manapadam. I use because this IBS institute is excellent in the sense they teach you in your mother tongue, Malayalam, Tamil, Telugu, Kannada, so that the concepts are clear. Okay. That is the unique proposition of I'm not here to market my institute, but then I'm glad to observe this type of unique features of Institute of Banking Studies. And they're all founder members also are all bankers. Okay, leverage ratio. Now, in one of the slides, I was talking about Lehman Brothers. Why did they fail? Their leverage ratio was more than 50 perhaps. So what is that leverage ratio? How to calculate what it is? You will find out from this. And what you do when you view my video, just pause it and calculations you can see that. Banker friends, they know about it. They've already done. I'm talking about other MBA and FRM and commerce students. Okay. I'm going to post this in YouTube also, so that it helps others also. A review of the financial crisis of 2008, the subprime lending crisis, has indicated that the value of many assets fell quicker than assumed from historical experience. So thus, now Basel III rules include a leverage ratio to serve as a safety net. The leverage ratio is the relative amount of capital to total assets. Here we are not taking a risk-weighted, total assets, total simple asset, not risk-weighted asset. This aims to put a cap on swelling of leverage. Otherwise, we go on borrowing. That's one of the reasons why Lehman Brothers failed. It was more than 50%. So this aims to put a cap on swelling of leverage in the banking sector on a global basis. 3% leverage ratio of Tier 1 will be tested before a mandatory leverage ratio that was introduced in 2018. Even year, when it was introduced, my banking friends, you should remember, in MCQ, sometimes, they have asked year also. Okay. When we should reach 2.5% of capital buffer ratio, it was last date given was 31st March 2019. You may, in fact, let me tell you, you are lucky. And during our days when we passed that CAIIB, there was no MCQs, very descriptive. Particularly, foreign exchange was very, very difficult. Most of the students used to fail in foreign exchange multiple times, and you are lucky there are no descriptive. Yes, there will be some scenario analysis, situation analysis. They will give a situation, and based on that they will ask 3-4 MCQs. And as far as I am concerned, on risk management, I have given you over 100 scenario analysis. I confess I have not prepared all those things, even though a few of them I have updated, I have edited, but prepared by experts, prepared by banking experts. I don't know how many of those who have really able to answer. I have given the answers for that also. Still one day is there. Tomorrow after Ganapati Puja, please, just have a quick glance. But first you read this slide and listen to my video. Then see MCQs, I don't know whether I have given answers, I don't remember. But for all the cases I have given the answers. Okay. So that's about leverage ratio. Next comes liquidity ratio. Under Basel III, a framework for liquidity risk is created, and this is known as LCR, liquidity coverage ratio. And one more point you have to remember, NSFR. Wantonly I am repeating this because there will be question. I'm sorry, not question means multiple choice. See, you are lucky. During our days, there was no hint. Here, if there are multiple out of 4, one answer will be there, a correct answer. Or if the question is such, which one is not the part of this? So there may be one wrong answer, or there may be, in other words, one correct answer. So you can guess also. You are really lucky in the sense. And if you have acquired that conceptual clarity, it is impossible to fail. What did I say? It is impossible. You will not fail. Okay. So, what is NSFR? That has to be already introduced starting from 15 to 18. The last day was March 2019. Few more things are there which have been postponed. Like for example. 0.625, that buffer has to be introduced. It was postponed because of this COVID to 1st October, coming next month. Similarly, this entire overall outcome has been postponed to 2023. another 2 years, because it is very extremely difficult. In fact, I think some international research agency has predicted we need 65 billion US dollars to comply with what Basel III wants. All those data also I have given, all the statistics I have given, that is for your benefit. Okay. Now I am recording through Zoom. I think it's already 35 minutes over, only 5 minutes, then I will stop. Then I will make it 3 parts, and the last part is only for India. What are the Reserve Bank of India guidelines? After 5 minutes I will stop, and then again we will come back. The last key element is systemically important financial institution. Systemically, in the risk, perhaps you are aware, there are 2 types of risk. One is systemic risk. Some people pronounce it as systematic. There is no systematic in risk. It is systemic risk, which is in the system itself, embedded in the system. Like for example, our income tax system, like our certain, for example, GST tax system. And unsystemic risk, which is not specific to sector or company, which are specific. I'm sorry, not specific, which are specific. The system, it's very difficult to eliminate the entire risk. Whereas unsystemic risk, which is not there in the system, which is specific to a particular sector, specific to a particular company, it can be managed. Okay. So another key elements for reforms is, particularly for such a financial institution. I think I will take another only 3 minutes and stop here. Now most of you must be aware. Can you see this picture here? That 3 pillars, Basel II. There are, and these 3 pillars remain the same even for Basel III also, with a little bit of modification, and we are going to apply these norms simultaneously, and both will work both for Basel II as well as Basel III. In other words, it remains even for Basel III also. What are those 3 important pillars? One is minimum capital requirements, that's 8% earlier, now 8 plus 2.5, okay, that is 10.5. Then the supervisory review process, monitoring, controlling. Then market discipline refers to your disclosure norms. What type of, I was telling you have to be transparent to your shareholder. So all type of risk that you are facing, and the risk mitigation tools that you are employing, and the outcome of your managing, mitigating risk, all these things will appear, will be dealt in pillar 1, pillar 2, pillar 3. In next 3-4 slides, I have given details. I am not going to read out as I told you. You please read, pause the video and read one by one. I will quickly change that. See, for example, what is pillar 1? Credit risk, operational risk, market. It is revised one under Basel III. The second one, then within the credit risk, there is a standardized approach. There is a foundation internal rating based approach. Earlier we simply used to base our credit decision based on ratings given, maybe CRISIL, CARE, ICRA, Moody, S&P, whatever, SMERA, etc. Now there are 2 types of credit rating, internal and as well as you can also, if you want, you can take external rating system also. You may be knowing, it's not we are undermining the competence of the credit rating agencies. There were cases when a corporate was given AAA ratings, AAA plus, and within 8 days it collapsed. It went for bankruptcy, appealed. Such things have happened, unfortunately. We will not go into the details. That is why now the system has been further strengthened. IRB, advanced IRB approach, risk, and under operational risk, basic indicator approach and standardized approach. What are these approaches? What are the formulas? All these things I have mentioned here later on. And then in market risk, again standardized approach and internal model approach. That is for pillar 1. Pillar 2 talks about supervisory process. Subba Rao is for, so there should not be any credit concentration risk. Exposure norms you have to take. Can I give only for particular sector or only for particular group of companies? That's what earlier happened. So now it is more well defined, and counterparty credit risk. Risks that are not covered in pillar 1 will be like, for example, for banking book, trading book, which encompasses liquidity risk, business risk, and which expect you to do what is known as stress testing. Pillar 2 I will complete on pillar 3, that is market discipline, explore disclosures, increase the transparency of lenders' risk profile. There will be big, that's exactly what I was mentioning. It runs to scores of pages if you go through annual report or K10 report of any financial institution. They are expected to give details of the risk management and the risk distributions. I think I'll stop here. It's 40 minutes. I'll make it 3 different pages. Part 1, part 2, part 3. Okay, I will come back. I will take 5 minutes rest here, and then I will come back.